Here's the thing nobody wants to hear. Warren Buffett became the fifth richest person on the planet by being boring, genuinely, aggressively boring. While everyone around him was chasing the hot stock tip, the crypto moonshot, or the real estate syndication with the fancy PowerPoint, Buffett was doing the same thing he's been doing for 70 years. And right now, in June 2026, when the S&P 500 is down almost 3% this month, when Bitcoin crashed 18%, when everyone's panicking about what the Fed's going to do next, this is exactly when his three most counterintuitive money rules become absolutely lethal. I'm going to walk you through all three of them, break down why they actually work in today's market, and show you the exact moves you need to make starting today. And I'm warning you right now, if you hear something that contradicts what you've been doing, that's probably the rule you need to listen to most. Let's start with rule number 1, and this one's going to sting. Buffett's first savage rule is this: boring beats flashy every single time, and if you're not bored by your investment strategy, you're probably losing money. Think about what's happening in the market right now. We've got headlines about Comcast soaring on a split plan. We've got new Fed Chair Kevin Warsh saying there's a huge problem with financial markets, and people are debating what that means for stocks. We've got quantum computing investors making moves, fashion trends being pitched as investment opportunities. There's noise everywhere, and that noise is expensive. Here's what Buffett actually does. He buys index funds. Specifically, he buys the S&P 500 through low-cost index funds. Not individual stocks, not sector bets, not cryptocurrency, not alternative investments. He buys a boring basket of 500 of the largest companies in America, and he holds it. The S&P 500 right now is at 728.99, down 2.9% this month. Most people see that number and think they need to do something, anything, to protect themselves or to jump in and catch the falling knife. Buffett sees that number and thinks absolutely nothing because he's already positioned. And here's why this matters. According to research from Vanguard and Fidelity, over any 20-year period, index funds beat 85 to 90% of actively managed funds. 85 to 90%. That's not luck, that's math. When you're paying a fund manager 2% a year to pick stocks and they're beating the market, they're not beating it by much. Maybe 1% a year. So you're paying 2% for a 1% advantage, which means you're down 1% before the day even starts. Boring wins. Now, the version of this rule for 2026 is different than it was in 2016 because the tools have changed. You're not limited to just the S&P 500 anymore. You've got access to fractional shares through apps like Fidelity, Schwab, and Vanguard. You can literally invest $40 a month into a total market index fund and own a tiny piece of thousands of companies. That's democratized wealth building in a way that didn't exist 5 years ago. The boring part is still boring. You pick an index fund, you set up automatic contributions, you never look at it. But the accessibility is incredible. Here's what you need to do right now. Open an account at Fidelity or Vanguard if you don't have one. Put 70% of the money you're going to invest this year into a total market index fund or an S&P 500 index fund. Set it to auto-invest. Never check the price. Close the app. Go about your life. That's Buffett rule number 1. Rule number 2 is where most people actually lose their minds because it requires you to think like someone from another planet. Buffett's second rule is this: compounding doesn't care about your timeline, and if you're not positioning for 25 plus years, you're not actually investing. You're gambling. Let me show you why this matters with real numbers. If you invest $10,000 today at an average annual return of 7%, which is roughly what the market has returned over the last 100 years, here's what happens. After 5 years, you have $14,000. After 10 years, you have $19,000. After 25 years, you have $784,000. That same $10,000. The first doubling takes about 10 years. The second doubling takes about 7 years. The third doubling takes about 5 years. Time doesn't add, it multiplies. But here's the problem. Most people don't think in 25-year chunks. We think in 4-year chunks because that's how long a presidency is, or 5-year chunks because that's how long a car loan is, or 1-year chunks because that's when our bonuses come. Buffett thinks in 50-year chunks. He's 96 years old, and he's still making 25-year bets. That's insane, unless you realize that he's not trying to win in 1 year or 5 years. He's trying to win forever. Here's what's interesting about right now in June 2026. We just came through a period where people were panicking about whether the Fed was going to raise rates or hold them steady. Reuters reported that economists are saying the Fed will hold rates for the rest of the year, which removes a lot of uncertainty. This is the kind of condition where people either panic sell and lock in losses or hold steady and let compounding work. Buffett holds steady. The actual application of rule number 2 in 2026 is this. If you have money that you're not going to need for the next 2 decades, it goes into the stock market today. Not next month. Today. Because every day you wait is a day that isn't compounding. If you have a child born today, any money you put into a 529 college savings plan is going to have 25 years to compound before they touch it. Using that same 7% average return, $5,000 today is going to be $53,000 by the time they're 18. If you wait 5 years to start, you miss out on $18,000. The tool for this in 2026 is a Roth IRA or a taxable brokerage account. Open the account, put the money in, set it to auto-invest, walk away. Don't check it, don't trade it, don't optimize it. Let compound interest do what it does, which is turn small amounts of consistent money into enormous sums over time. That's rule number 2. Now we get to rule number 3. And this is the one that actually separates people like Buffett from everyone else. This is the rule about your biggest wealth enemy. And I'm telling you right now, it's not inflation. It's not market volatility. It's not interest rates. It's you. Buffett's third savage rule is this. Your behavior is more important than your strategy. And if you don't have the discipline to stick to a boring plan during chaos, no strategy will ever work. Let me show you what I mean. We're in June 2026. Bitcoin is down 18% this month. Gold is down 8.5% this month. The Nasdaq is down 3.1%. The Dow is actually up 2.1%, which creates this weird divergence that makes people think something's broken in the market. Your instinct right now is probably to either panic sell or to chase something that's working. Both of those instincts are wealth killers. Buffett talks about this as the difference between being greedy when others are fearful and being fearful when others are greedy. What that actually means is when the market is down and scary, you buy. When the market is up and everyone's excited, you do nothing. That's the entire strategy. But executing that strategy requires you to have the psychological fortitude to do the opposite of what your brain is telling you to do. Here's the reality of behavioral finance in 2026. We have more information than we've ever had, more tools than we've ever had, and we're making worse decisions faster than we've ever made them. 30 years ago, if you wanted to check your stock portfolio, you had to call your broker or wait for the newspaper. That friction kept you from making emotional decisions. Now you've got an app that shows you your net worth down to the dollar, and it updates in real time. Every market movement hits you emotionally in real time. The solution to rule number 3 is actually deceptively simple. You have to build systems that remove you from the decision-making process. Set up automatic contributions. Set up automatic dividend reinvestment. Set up automatic rebalancing if you're diversified across multiple asset classes. Remove emotion. Remove decisions. Remove yourself. This is why Buffett automated his wealth building 70 years ago and hasn't changed it. He's removed the variable that matters most. Him. So here's how you apply all 3 rules right now, starting today. First, go open a brokerage account if you don't have one. Fidelity, Vanguard, Schwab, Charles Schwab, Webull, they all work. Second, figure out what money you won't need for the next 2 decades and put it in an index fund. All of it. 70% S&P 500, maybe 20% international developed markets through an ETF like VXS, 10% bonds through BND or similar. Set up automatic monthly contributions. Third, automate everything so that you never have to think about it. Set it and forget it. Close the app. Go make more money. That's how you compound. The reason this matters right now in June 2026 is because we're in a period where there's genuine uncertainty in the market, and uncertainty is where behavioral mistakes happen most. You're going to see headlines about Fed policy, about market volatility, about inflation, about geopolitical issues like the situation with Iran and the Strait of Hormuz that could affect oil prices and markets. You're going to feel the urge to do something. That urge is going to cost you 70 to 80% of your potential wealth if you act on it. Buffett's entire edge isn't intelligence. It's not even luck. It's discipline. It's the willingness to be boring while everyone around you is panicking. One last thing. Buffett's been saying for years that one of the best investments an average person can make is in themselves. A Texas high school is now requiring personal finance education for graduation, and Bloomberg just highlighted that high schools across the country are emphasizing personal finance. That's fantastic, but most of it is too late. You need to be building these habits in your 20s and 30s, not learning about them in high school. You're ahead of most people just by watching this and thinking about your strategy. So here's what I want you to do. Tell me in the comments which of these 3 rules you're going to implement first. Are you going to open an account and start boring index fund investing? Are you going to commit to a 25-year timeline? Or are you going to build the systems that remove emotion from your decisions? I read every comment, and I'm genuinely curious what resonates with you. And if you got value out of this, please subscribe. We put out new content every week about exactly this kind of stuff. Real strategies that work in today's market, not theory that worked 5 years ago. Thanks for watching, and I'll see you in the next one.